Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. Today is Monday, November the 8th, 2010, and like we do every night, it's time to look at the markets. Check this out. Okay, today we're going to be doing something a little bit different. We're going to go over the fundamental picture, the whole thing for everybody, so everybody gets an idea of what's going on. You got to really be able to look at the map to understand the pieces of the puzzle that they toss out every now and then on the news, whether it's the unemployment side or the housing numbers or whatever, the consumer spending. All those are just pieces of an overall picture. So we want to draw that overall picture out for you so you get a really good understanding of what's going on and you can see the opportunities that are out there. If you've been following us at PerfectStockAlert.com for any length of time, you know that we use both technicals and fundamentals to get a clearer picture of what's going on and then to improve our success rate. And it's pretty effective. We don't believe that technicals are superior to fundamentals or vice versa. Each one has its strengths and weaknesses, but when you combine them together, you get a much clearer picture. So let's go over this right quick. The first thing is to simplify, okay? Go back to the beginning of this crash. You have to understand that no asset goes straight up or straight down. So there's always going to be a peak or a bottom, all right? So when you had the housing taken off and then it peaked, okay? House start to fall, what's the first thing that happens? Well, consumers, who is the borrower, gets hit. At the same time, banks, who is the lender, gets hit. This results in one action from both sides, okay? The consumer is going to stop spending. That's just, as soon as they're under pressure, they stop spending money. The banks become under pressure. The first thing they do is they stop loaning money. They stop spending money, okay, so to speak. So that's their immediate response. When they did that, everybody else who may have not even been involved with the real estate market became hit, most of them. Our economy in the U.S. is 70% driven by consumers. When consumers stop spending, everybody's business gets hurt, all right? That they're looking on selling product or services or ideas or whatnot to these consumers. And if they stop purchasing it, then that's the end of the game. So they do what they had to do to protect them. They get hit, so the companies say, all right, we got to cut fat. So they start slicing expenses they don't need, basically jobs that they didn't need to support anymore. So when they do that, unemployment increases. You guys know the story, okay? So this thing continues and continues and continues. And got so bad, government says, okay, we've got to do something. So they bail out a lot of the Wall Street firms. They bail out your major commercial banks. Remember, they're not looking so much at the smaller banks. They're focusing on the big institutions. That's important to note. So the first thing they did is they took the assets, the bad assets, off of these banks' balance sheets, stuck them on the Fed or wherever, and then they infused them with cash. That's important to note as well. Now the bailout was stated as being a way to get banks to start lending again. You know that's not true. You know that for fundamental reasons. First off, they never would have started lending to subprime had prime still been available. In other words, the pool of quality opportunities to lend to, the prime people, or the prime situations to make investments there, were gone. So they started branching out and getting deeper and deeper into subprime. When they were told by the government, okay, here's the money, now you can start lending again, they look across the board with these new higher standards that they had all set on themselves and said, there's no one to lend to. That's why they're not lending. Okay, it's not going to change. The QE1 didn't work. You know that because the GDP didn't grow exponentially. It's actually just barely alive, and that's with all that government spending. So we have no reason to believe that QE2 will do any different. What we do know is that your government have got a lot of people who are unemployed, 20% here in the U.S. So when you've got all this unemployment going on, 10.1 was the high reported number, you had to do something to keep people from rioting in the streets. So you extend unemployment benefits. Well, we're up to 99 weeks now. Okay, well that's a lot of money going out. You tack in the money that we've put into the banks, or the government's put into the banks to make them more structurally sound. That's a lot of money going from the government out to help keep its economy from dying, and yet they were already substantially in debt, the government itself. So with the recession in play, you don't have any or not a lot of tax revenue coming in to the government. So you've got these crunch time going on in the government as well as in the individual companies as well as in the individual people themselves, as well as in the banks and so on. But the banks have now been resolved. Remember that, okay? The banks have been flushed full of cash. The bad assets, a lot of them have been taken off their balance sheets. So a lot of your banks, your quality banks, are sitting pretty right now. I'll talk about that in a minute. So that whole story we just painted out for you is the story, what's going on in the market. But that didn't just happen in the U.S. That happened around the globe. So we've already seen people have ostracized what they call the pigs. Okay, Portugal, Ireland, Italy, Greece, Spain, toss in Hungary if you like. And you've got these countries that before Greece ever defaulted, we said that will default. It's going to happen. You can count on it. Now, how do we know that? Because of the way it works fundamentally. A bond trader walks into the bond market, and Greece walks up to them and says, "Hey, we need your money." He says, "Yeah, I know you do, but it's kind of risky, so I'm going to need a premium." And they say, "Well, what do you need?" He says, "I'm going to need 6% today." They say, "Okay, we can do it. It's a little tight, but all right, we can do it." The next day he walks into the bond market. Greece says, "Hey, we need some money." He says, "I know, but now you're paying 6% on your debt. That's going to make it that much harder for you to actually say, solve it and actually make this thing work. So now I'm going to need a little bit more because there's so much more risk involved. I'm going to need 7%. And Greece says, "Man, that's tough, but okay." This game continues and continues, and it keeps ticking higher and higher until I think Greece got to like 10% before they said, "You know what? We cannot afford 10%." And they call the IMF, all right, for a bailout. So that's something you could look at and say, this is going to happen, plain and simple. It would result in default. If you look at the picture from a small perspective of a whole bunch of people in the U.S. get overextended, some of them will ultimately file bankruptcy. If you look at it from the perspective of the banks, you can say, okay, a whole bunch of banks got overextended. Some of them would file, would go under, okay, and that happened. If you look at other individual companies, you can say, okay, they get overextended. Some of them will in fact fail, and they did. You look at the countries and you say some of them were worse off than others from a debt perspective and the income they had going on. Some of them would ultimately fail. That's just a fact of the game, okay? So when we talked about before the situation was going to happen to Greece and then it actually happened, when we're talking to you now about Ireland going through the exact same process last week, every single day, their debt payments ticked higher, ticked higher, ticked higher. That's important. 7% for them is already foreseen, and 7% is only 3% away from 10%. So give you an idea of how close we are to this thing happening, okay? When that happens, you're going to get the end result of a sell-off, and that's important. Okay, here we are looking at the FTSE, which is my way of looking at what's going on over there in Europe. This is the London Financial Times Index. You can look at other charts. I prefer to look at this one. You'll notice here that we followed the exact same pattern as the U.S. And we have, in the FTSE, it just bounced right back up from September all the way to the current period. We just rallied ahead of the Fed. The Fed isn't going to save them. At the end of the day, anything that the Fed does helps our banks and may create opportunity for some companies to actually borrow from the banks, but not the majority of them. We'll get to that later. The main thing here is that this doesn't change anything for Europe. That's why even last week the Ireland situation was just getting worse and worse and worse. Portugal, same way. Okay, so that's fixing to collapse. When that collapses, you will see a major sell-off. When the sell-off happens overseas, the U.S. here will also follow. When that following happens, when people start selling stock, they're doing something. When they sell stock, they're buying dollars. When they buy dollars, it will drive the price of the dollar back up. So all the move that the Fed's doing here to try to lower our dollar and somehow stimulate other countries to buy from us is actually not going to end up working. If you go back and look at the dollar chart, let's do it that right quick. Okay, looking here at the U.S. dollar index, you can see that back in the 08, worst part of 2008, the dollar shoots way up because people are selling stock, which means that they are trading stock in for what? Dollars. So that drives up the price of the value of the dollar. Happened same time here back in April when we had the flash crash, all the situation. All right, so now when they're saying we've sold it off so we can somehow make it more appealing, give us more deals than other countries, it doesn't work that way. Other countries simply go into the same process. It's called the currency war is going on where everybody just devalues equally. And again, it doesn't change the fact that when you start selling off over in Europe, which is going to happen, you're going to end up driving up the dollar anyway. So the only thing that the QE2 actually did do was two things. One, put money back into banks, which is something you need to pay attention to. And two, it's going to drive up things like gold, silver, oil. Oil is important. oil translates to higher gas prices, which puts more strain on the U.S. economy. So ultimately, from a looking at the situation, we can say nothing's changed. We're not out of the woods here from a fundamental perspective. You, in fact, should see lower stock prices, not higher. And that would go with our analysis from Thursday on that video titled Am I Wrong? Where we show you perfect technical proof that the market is in fact peaking. So you want to be using this situation and this knowledge to anticipate lower stock prices because of the sell-off is going to happen in Europe. The thing I will point out about this, there's good news, two good news items. Number one, once countries fall, there's no one else left to fall. Pets don't have debt. God doesn't have debt. So once people, banks, companies, and countries have all been taking their hits, once that's done, the thing's been washed through it. The worst that's going to happen has happened. So I would use the sell-off in Europe, the sell-off that ends up following here because of the sell-off in Europe, I would use that as an opportunity to buy. And like I just pointed out, the banks have already had their problems resolved. Well, some of the banks, I won't say all of them. You can do your own research on that. But the main thing is that there are banks out there that are not seeing the same structural problems that they used to have. So that would be where I would be focusing. My long-term investment side, if I got a really nice sell-off in Europe, something like that also followed here in the U.S., I'd use that as a buying opportunity. Okay? Now you understand what I'm talking about when I'm saying I'm going to become a bull once we get to the bottom. Well, once that bottom hits, once we get that major sell-off that I'm looking for, then I would go shopping. All right? That's where I want to be doing my buying. All right, now you know. Okay, if you've not been to our free website at perfectstockalert.com, it's right there. It's 100% free. All we ask in return, please refer a friend. We got a whole bunch of videos right here going over all kinds of different technical analysis tricks and tips for you right there, including some trading methods and nightly market analysis videos. All the charts that I go over every day are always kept right here with my notes on them in case I don't do one for one particular night that you want me to look at. And go ahead and check it out there on the website. MPT rating, which will tell you what we expect for the market the next day, what we expect it to do, whether up or down, or so forth and so on. And we have a traders forum in here, which lots of smart investors and traders in there every single night posting their analysis, their stock picks, their different ideas. So that's always good. And let's see what else we got here. Nightly scans, pretty cool feature there, and swing trading course, lots of good stuff there. Hope to see you all there. God bless. Take care. Let's have a quick look at our disclaimer. The disclaimer, read it and weep. God bless. Take care. I'll see you in the next video.